Peak Wealth Management proudly presents the Trust the Plan podcast with Nick Hopwood and Jim Pilat, where we believe by providing education and guidance, we can help you retire with peak confidence. Now, here are your certified financial planners, Nick and Jim.
Welcome everyone to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And Jim, I believe this is the Feel Good edition.
It's always a fan favorite.
Yep, that's right. So, we just released the much anticipated Evan Chop episode last week.
Oh, yeah.
It's been a fan favorite already.
Is it?
Yeah.
The numbers look good, huh?
Yeah.
It's a great topic.
It is. And I have to say, since Evan came on, I already saved like $240 on the Delta Amex card with credits from Amex.
Nice.
One was for a hotel for $200. No, it was actually $290. $250 for a hotel credit, just booking it through Delta.
Yeah.
And we were gonna stay in the hotel anyway. In fact, we actually canceled a hotel room and then rebooked it through Delta to get the credit.
And you saved $250.
Yeah.
Nice.
And then Campari's here in town through the Resi. I think we were talking about Resi, but I think it's actually Resi. R-E-S-Y.
Okay. Yeah.
On the Resi program is Campari's, and so if you use your enrolled card at Campari's, you instantly get the $20 credit per month. So I've done that twice now.
What a deal.
I know.
That's good. It's good stuff.
It's excellent. Yeah. So if you didn't see last week's episode with Evan, check it out. But today, Jim, we want to talk about what the Wall Street Journal is calling the cash trap.
Okay.
So let's pull up this article here. The cash trap. Americans chasing high interest rates risk falling into a cash trap. Okay? So when we think of cash, we're thinking of money markets primarily.
Yeah.
Outside of the bank, of course. We think of money markets as the go-to vehicle for cash. Or some people are using T-bills outright. But, those are 30-day instruments, so they're short-term. So the subtitle here is Investors Must Decide Whether to Sit on Their Cash or Redistribute It Ahead of Expected Rate Cuts. So let's break that down. Now, expected rate cuts. As of now, the market is anticipating one rate cut before the end of the year.
Yeah.
But guess what? It was the same thing at this time last year. They were expecting one rate cut before the end of the year.
And a few the following year. So we're obviously behind that pace already.
Yeah, it wasn't long ago when they were expecting 4 rate cuts this year.
Right.
So here we are in late June, and they're saying one rate cut, and it may or may not happen.
Very true.
So if there's no rate cuts, money markets are going to be sitting there at like 5.18%. And this is the crux of the article, right? Like if I'm making my 5.18 or a T-bill's 5.35, pretty fat and happy, right?
Yeah, definitely. I mean, that's why we've been talking about it for so long. It's a great place, to put some money, to earn a good rate on safe money. We're not exposed to volatility on that, so that's exciting.
So the money markets, I think most of us or most of you should be familiar with, but since rates have been high for over a year now, we've been really taking a deep dive and saying, well, where's the best place to be? And we're in Michigan. We have a lot of clients in Michigan and Ohio, for instance, where the state tax rate is 4 or 5%. And what's interesting is that the Treasury bills, T-bills, if you ignore the money market and just go right to the T-bill, you're going to get a little higher rate because you're avoiding the money market cost. But then you're also completely avoiding the state income tax. And so if the money market yield is 5.18, and it has some treasuries and some other things in there, so it's fully taxable, versus a T-bill at 5.35, which is state tax-free. And if your state tax rate's 4 point something, you're actually getting an extra 0.2 tax equivalent yield. So it's like 5.55 versus 5.18.
Right.
And if you have a lot of money in that money market, maybe something to consider. Takes more work.
Yeah.
You have to place trades, and back in the day it used to be cost prohibitive because like LPL would charge like $250 to buy a bond.
Yeah.
Those days are over. Okay, it's basically free. There's no cost to buy a treasury. You can do it every month.
Yeah, I guess the potential downside, right, is if, and we don't think that would happen, but if they started raising rates again, the value of that bond could potentially go down a little bit. Small because it's a short-term instrument. But
So we just hold on for the remaining
Yeah.
25 days and we get par.
yeah,
So I don't really worry about that. But really, what I think about this article, and I think about this all the time. Question is the money market the best place to be, or T-bills? Let's just call it cash. Is that the best place to be? Like I said, we're fat and happy making that. But what if, we don't need that money for a long time?
yeah, I think, and I'm sure that's where the article's going, but you definitely have to be aware that it's not a long-term investment. It's a short-term holding place, but looking at it as a long-term investment, I think you're setting yourself up for some disappointment.
And as this chart shows, we've got over $6 trillion in money market funds, which is basically double where we were 10 years ago. So a lot of people are in this trade right now, okay? My argument is we only need this money in money markets and T-bills if we are using it for our emergency fund or if we are using it for a specific goal, maybe 1 or 2 years out. For instance, a new car, a new house, college money that you need, or the next year or two of retirement needs, right?
Yep.
Otherwise, I think that what's going to happen is the Fed's going to start cutting, maybe at the end of the year or next year. All of a sudden, we're going to wake up and these rates are going to be back at 3% instead of 5 point something.
Yeah.
And when that happens, we're going to be less excited about the money markets. And we're probably going to be regretting the fact that we didn't have the money in longer term bonds.
Right, because we're going to miss the price appreciation on those bonds.
Yep. And that's what JP Morgan is calling the cash trap. Okay.
Okay.
So, if you've owned cash over the last year and a half, you've been great, but that's the rear view mirror.
Yeah.
So looking forward, what if I told you if you bought intermediate or longer term bonds, you can make more than 5.18%, and when rates do go down, you have capital appreciation.
Yeah.
That's exciting. What if I told you that if the yield is larger than 5.18, that's your expected return for the next 5 years? Well, that's pretty exciting.
Yeah.
We haven't been able to say that very much.
Yeah. So if you have a time horizon that can accommodate 5 years or so, that I think you definitely want to start thinking about taking that extra step.
This is well said here from Vanguard. Long-term investors should return to a diversified bond portfolio so they can lock in these attractive long-term yields before the Fed starts cutting rates. That's the gist of my argument. Unless you need that money in the very short term, we should think about locking in these higher rates for longer.
Yeah. Because I think that's the trap, is that if we just keep being comfortable, eventually they're going to start cutting those rates. And like you said, we're going to wake up one day and be in the 3s and go, how did that happen? And all the while, we just missed some price appreciation on the bonds and could have locked in a 5. So I think it's great.
So with that said, if you have a lot of money in the bank paying 0.05, a money market would be a great place to consider. We'd be happy to help you with that. If you have too much money in the money market and you're thinking about long-term investment plans, we can help you with that as well. So if you enjoy what we're talking about here, please watch on YouTube, ring the bell, subscribe, like, share. Be grateful if you do that. And if you're interested in speaking further, you can sign up for an appointment at peakwm.com.
Peak Wealth Management thanks you for watching and listening to the Trust the Plan podcast, featuring certified financial planners Nick Hopwood and Jim Pilat. If you enjoyed our program, please subscribe and share. If you'd like to learn more about our services, please visit peakwm.com. peakwm.com today. See you next week.